Open your banking app right now. Look at that number. Your checking account, your savings account, maybe a CD you set up last year because the rate finally made it worth it. That number feels real. It feels like yours. It feels like it's sitting somewhere in a vault with your name on it. It isn't. The moment you deposited that money, it stopped being yours in any meaningful legal sense. It became a loan. You loaned it to the bank owes you that number back. And the only thing standing between you and the reality of what that means is a system of guarantees, assumptions, and institutions that most Americans have never looked at closely, because they've never had to, until March 2023, when they had to. In 48 hours, Silicon Valley Bank, the 16th largest bank in the United States, a federally regulated institution with $209 billion in assets, ceased to exist, not because of fraud, not because of reckless consumer lending, because of a duration mismatch in its bond portfolio and a bank run that social media accelerated from a slow bleed into a full cardiac arrest in less than 2 days. The FDIC took it over on a Friday morning. By Friday afternoon, 93% of deposits, $151 billion, were technically uninsured, sitting above the $250,000 FDIC limit. A 61-year-old biotech executive in San Jose named Carol Whitfield had $1.8 million in her company's SVB operating account. That was payroll. That was vendor payments. That was the money her 34 employees were expecting on the 15th. She spent that Friday making calls, unable to reach anyone, watching a number on a screen that she could not access, and did not know if she would ever see again. The federal government stepped in that weekend and made depositors whole. This time? But here's the question. Carol's story forces you to ask, what is your plan if they don't step in next time? Not because you're a pessimist, because you're an adult who has now watched 3 mid-size American banks fail in a single calendar year: SVB, Signature Bank, and First Republic. And you understand that assuming the government will always intervene in time is not a financial strategy. It is a wish. The FDIC Insurance Fund, as of early 2024, holds approximately $117 billion. The total deposits in American banks exceeds $17 trillion. That is an insurance ratio of less than 1.4%. In plain language, if a significant banking stress event triggered simultaneous withdrawals across multiple institutions, the FDIC's capacity to make depositors whole would be exhausted before it reached the third bank on the list. This is not a conspiracy theory. This is publicly available math from the FDIC's own quarterly reports. The fund is designed to handle individual bank failures, not systemic ones. It was never designed for 2008. It was never designed for a world where a tweet can move $42 billion out of a bank in a single day, which is exactly what happened to SVB. The system is not built for the speed at which it can now fail. So the real question, the one this video is actually about, is not whether banks can collapse. History answers that. Between 1980 and 1994, over 1,600 American banks and savings institutions failed during the savings and loan crisis. In 2008 and 2009, 165 banks failed. In 2023, 3 banks failed in 90 days, holding more combined assets than all 25 banks that failed during the entire 2008 crisis. The question is not if. The question is, where does your money survive when it happens? And why do almost no financial advisors ever walk you through that answer clearly before you need it? Let me tell you exactly where. And more importantly, why each place works when the system around it doesn't. The first answer is the one most people know and almost nobody fully understands. FDIC insurance covers $250,000 per depositor, per institution, per ownership category. That last phrase, per ownership category, is the one that changes the math entirely and that most bank customers have never been walked through by anyone. A married couple can structure accounts across individual, joint, and retirement ownership categories at a single FDIC-insured institution and protect well over $1 million without opening accounts at multiple banks. An individual with an IRA, a standard checking account, and a payable on death account structured correctly can protect $750,000 at one bank. Most people with more than $250,000 in deposits have never had this conversation with their bank. They either assume they're covered or assume they're not and do nothing about it. The bank does not proactively volunteer this information. There is no financial incentive for them to do so. In March 2023, a 58-year-old small business owner in Austin named James Kowalski had $380,000 in a single checking account at a regional bank that was showing stress signals. A friend mentioned the ownership category structure to him 4 days before that bank was placed under FDIC supervision. James restructured his accounts in 48 hours and protected his entire balance. The friend who told him learned it from a YouTube video, not from his banker, not from his financial advisor. The people closest to your money are not always the people most motivated to protect it. Drop a comment right now and tell me, Has your bank or financial advisor ever walked you through FDIC ownership categories and how to maximize your coverage? I want to know how many of you have had that conversation. Because based on what I've seen, it's a small number. The second place your money survives is one that most Americans over 45 have heard of and treated as too complicated, too old-fashioned, or too low-yield to bother with. Treasury securities, specifically T-bills, Treasury notes, and I-bonds, are not deposits. They are not bank products. They are direct obligations of the United States federal government, held in your name at treasurydirect.gov, sitting entirely outside the banking system. If every bank in America closed tomorrow, your Treasury holdings would be unaffected. They are not FDIC insured because they do not need to be. The credit standing behind them is not an insurance fund with a 1.4% coverage ratio. It is the full taxing authority of the federal government. A 66-year-old retired postal worker in Cincinnati named Dorothy Fields had watched the 2008 crisis from the sidelines with $140,000 in a savings account at Washington Mutual, which failed in September 2008, in the largest bank failure in American history. She was made whole by the FDIC that time, but she spent 3 weeks not knowing if she would be. In 2020, when COVID triggered a brief but severe liquidity panic, Dorothy had $200,000 in T-bills she had been rolling over for 6 years. She watched the news. She felt nothing about her money, not because she wasn't paying attention, because she understood that what she owned was not a promise from a bank. It was a promise from the institution, with the ability to print the currency the promise is denominated in. That is a different kind of safe. The third place your money survives is the one that feels the most counterintuitive in a crisis, and has the most historical evidence behind it. Hard assets, not gold coins buried in your backyard, which is the caricature that stops most serious people from engaging with this idea. The actual history of banking collapses across the 20th century. Weimar Germany, Argentina, 2001, Cyprus, 2013, the American S&L crisis shows a consistent pattern. The people who preserved the most wealth held some portion of it in things that exist outside the ledger. Real estate with no mortgage, productive land, physical precious metals held outside the banking system, not in a bank's safe deposit box, which is not FDIC insured, and which becomes inaccessible the moment the bank is placed under regulatory control. In Cyprus, in 2013, the European Union and the IMF approved a bailout that included a bail-in, a forced confiscation of a percentage of uninsured bank deposits to recapitalize the failed banks. A 62-year-old Cypriot restaurant owner named Andreas Petro lost 47.5% of everything above $100,000 in his business account. Overnight, legally, with the approval of his own government and the European Central Bank. He had spent 30 years building that balance. It was gone in a weekend policy decision made in Brussels. Cyprus was not a failed state. Cyprus was a European Union member nation with functioning democratic institutions and a modern banking system. And the government took a percentage of his savings to pay for the bank's mistakes. This is not ancient history. It happened in 2013, and the legal framework that made it possible, the bail-in mechanism, was subsequently adopted as policy guidance by the Financial Stability Board for systemically important financial institutions in the United States, the EU, and the UK. It has never been used here. It is available to be used here. Most Americans do not know it exists. The fourth place your money survives is the one the financial industry has the most complicated relationship with, because it partially competes with their products, credit unions. Federally insured credit unions are covered by the National Credit Union Administration, a separate federal insurance system from the FDIC, with the same $250,000 base coverage. More importantly, credit unions are member-owned cooperatives. They do not have shareholders demanding yield. They do not have incentive structures that reward short-term risk-taking with long-term depositor exposure. The 2008 crisis hit credit unions significantly less severely than commercial banks. The 2023 regional banking crisis did not produce a single major credit union failure. That is not a coincidence. That is a structural difference in incentive architecture. A 64-year-old union electrician in Pittsburgh named Frank DeLuca has banked at the same credit union for 31 years. During 2023, when his brother-in-law was scrambling to figure out his SVB exposure, Frank watched the news with mild interest. He has never had a conversation about whether his deposits were safe. Not because he doesn't pay attention, because his institution's structure doesn't produce the risk his brother-in-law's did. Structure is destiny in banking. The structure you choose before a crisis determines your experience during one. Now here's the historical context that makes all of this something other than fear-mongering. Because the point of this video is not to scare you. It is to locate you correctly in time. The American banking system has been through 5 distinct periods of systemic stress since the Federal Reserve was created in 1913, the 1930s, the S&L crisis of the 1980s, the 2008 financial crisis, the 2023 regional bank failures. In every single one of those periods, the pattern was identical. The warning signs were present months to years in advance in the data. The public was not informed clearly. The people who had structured their assets correctly before the event experienced the crisis as a news story. The people who hadn't experienced it as a personal catastrophe. This is not bad luck. This is the predictable result of a system in which the institutions holding your money have a direct financial interest in your believing that system is safe, right up until the moment it isn't. The bank does not send you a letter saying, "Our duration mismatch is creating concentration risk in our bond portfolio, and you may want to review your uninsured exposure." The regulator does not call you. The financial advisor, whose compensation depends on assets under management, does not proactively walk you through the FDIC ownership categories that might move your money out of a product he manages. The information to protect yourself is entirely public. It is on the FDIC website. It is in the Treasury direct documentation. It is in 30 years of post-crisis academic literature. It has simply never been assembled clearly for the person sitting in front of a banking app, wondering if that number is as real as it looks. It is real, for now, under current conditions, with current government policy. And the job of an adult in 2025 is to have a clear answer to the question of what happens to that number if those conditions change, before they change, not after. If this video made you want to check your FDIC coverage structure before you go to sleep tonight, hit the like button, not for the algorithm, for the next person who finds this video the week after their bank is in the news and needs this information right now. Subscribe, because next week I'm covering the specific legal mechanism, the bail-in framework, that was quietly adopted by American banking regulators after 2013, and that almost no retail depositor has ever read clearly explained in plain English. That video is called Your Deposit, Their Lifeline. If you have more than $50,000 in any single bank account, that video is directly about your money. Subscribe before it publishes. And tell me in the comments, before today, did you know that FDIC coverage has ownership categories that can multiply your protected amount? Yes or no? That answer tells me exactly what this channel needs to cover next. And I read every comment myself. Not a team, not an algorithm. Me.